The Property Bulletin by London Property, the home of superprime.
The government has abolished the 2-year rule for leasehold properties under the Leasehold and Freehold Reform Act 2024, enabling buyers to immediately apply to buy their freehold or extend their lease. Key changes introduced by the Act include lease extensions. Leaseholders can now extend leases to 990 years for houses and flats, a significant increase from 50 and 90 years respectively. Reduced costs. Measures to make buying freeholds and extending leases more affordable and straightforward. Improved transparency. Standardized service charge bills and increased rights to challenge unreasonable charges. Building management. Easier processes for leaseholders to manage buildings and appoint managing agents. Quicker transactions. Maximum timeframes and fees for buying or selling leasehold properties. Redress schemes. Access for leaseholders to challenge poor practices by freeholders. While these reforms are welcomed, experts, including Property Mark and Homehold, note more comprehensive changes are needed, particularly around lease extension affordability and implementing secondary legislation to fully enact the Act. Concerns remain over excessive charges and delays in addressing the broader leasehold system's issues. The Home, a 40-bedroom mansion in Regent's Park, previously owned by Saudi royal Prince Khalid bin Sultan Al Saud, has been sold for £138.9 million, well below its initial £250 million asking price. Built in 1818, the mansion spans 29,000 square feet, with 4 acres of gardens near Regent's Park's boating lake. Originally purchased by Prince Khalid in 1991, it was put on the market in 2023 after a loan secured against it expired. Registered under a UK subsidiary of Zedra, a Luxembourg-based corporate service firm, the ultimate owner remains unknown, despite regulations requiring offshore entities to declare ownership. The sale highlights transparency issues in UK property markets, as trusts and offshore structures continue to obscure true ownership. Labour's housing policy to build 1.5 million homes in 5 years may risk worsening the so-called housing crisis by relying on profit-driven developers who limit supply and affordable housing. Some say that simply increasing construction will not resolve the core issue of high housing costs, as homes are often treated as investments rather than necessities. Investor demand, including from foreign buyers, drives prices up, while it is claimed that almost 1 million homes remain empty and 8.8 million are underoccupied. Left-wing activists like George Monbiot argue that reforms to taxation, planning and council tax, as well as rent controls, could curb speculative demand, somehow redistribute housing and improve affordability without environmental harm. Without addressing these structural issues, they say, Labour's strategy may expand a system they see as dysfunctional, deepen inequalities and erode public trust. Social media influencers like KSI, Molly May Haig and Grace Beverley are investing in London's prime property market, acquiring multi-million-pound homes in prestigious neighbourhoods such as Mayfair, Hampstead and Notting Hill. These purchases reflect a shift among influencers to secure their wealth through real estate, as their online earnings are subject to volatility. Many influencers, often under 30, have significant buying power, earning through advertising revenue, brand partnerships, and launching their own products. They seek properties with aesthetic appeal and often integrate workspaces into their homes to align with their content creation needs. This trend has prompted estate agents to adapt, with younger agents leveraging social media to connect with this emerging demographic of buyers. Influencers' property choices mirror those of traditional affluent buyers, favouring established areas for investment stability. Norway's sovereign wealth fund has acquired a 25% stake in a mixed-use property portfolio in London's Mayfair for £305.7 million. The portfolio spans 2.3 million square feet, primarily comprising office and retail spaces concentrated around Grosvenor Street and Mount Street, according to a statement from the fund. Grosvenor, the real estate group, sold the stake but retains a 75% interest and will continue to manage the properties. The deal values the entire portfolio at £1.223 billion.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the superprime property market.